This is the second episode to our mini-series Entering the China Tech Dragon. In this episode, Mark will talk all about how a tech company could enter the China market. Mark, please take it away.
So we put together this simple flow chart, and obviously, certain aspects will be covered in different episodes. But so basically, I think the main issues to consider for a tech company is: can I operate onshore in China, or do I have to operate offshore? Have I got restrictions? How much do I have to invest? And how can I retain control over my technology, but also perhaps the entity? And one thing which many people don't think about is what kind of exit you want. Because companies do not last forever, even though they could technically. But what kind of exit? Very few people think about the exit. They consider the entry. So before you start, you should just make sure: do you have a business case for China? Have you registered your IP? Do you have a Chinese brand? Is the business restricted in full or in part? And then I guess that leads to the next issue, which is it legally possible for me to operate this business myself as a foreign investor? If yes, then you've got two choices. You can do your own wholly foreign-owned enterprise, which means that it's a company 100% owned by yourself. And in that kind of company, it's, the issues are more simple. It's where are you going to locate? And that's normally either Shanghai or Beijing. And then perhaps what kind of subsidies you can get from the local investment, local authorities. And then HR issues, how do you hire the right people, etc. If you're looking at a joint venture partner, normally they will have to bring something if it's not a legal requirement. So you might think they can bring you the distribution channels, they might have the market knowledge, or there might be an exit with an IPO or something like that. Or you might just think, I can do North America and Europe, but China probably need a partner to handle. The only other quick thing to talk about is that some companies which are not able to operate in China, their business fully, they will set up a wholly foreign-owned enterprise to do marketing and sales support, but then the restricted business will be operated by a company called a VIE, which will hold the licenses. And that VIE company is owned by Chinese domestic shareholders, but there are contractual relationships. That's quite a complicated area, so we'll cover that in a different episode. So the first issue is perhaps onshore or offshore. And I think most of the clients that we have who are digital companies or tech companies, they are already operating somehow with China. They've got Chinese customers or they have global customers in China. Many tech companies have areas which are sensitive or restricted foreign investment. And that's one threshold, but perhaps even more difficult is the operational licenses. Because sometimes those operational licenses are available on paper, but don't get approved in practice. And then also sometimes the actual investment to obtain an operational license is too high, especially for a company that doesn't have a market already built in China. So it's a little bit of a chicken and egg situation. And so for this reason, a lot of our foreign tech clients, especially value-added telco, cloud-based software as a service and media companies, they'll initially operate offshore via Chinese distributors or partners, but then they do come up with a problem because the market's limited. Because operating offshore mostly means you're limited to renminbi sales. You're often limited to consumer sales because businesses need the right kind of invoices. And you're reliant on local PRC distributors. And also, finally, very often the PRC distributors will not market or provide the sales support that you'd like to offer in the territory. So I think what we do see is a lot of foreign tech companies will start with an offshore and then they will transition to a WOFE to provide market and sales support. So I think the second issue that people should ask themselves is, what is my ambition about this market? For many Western tech companies, they think, okay, Europe and North America, I can handle that directly. Or my product or service is pretty niche. I can do it in China by myself. And then the third bucket is China, it's too big to ignore. And it's not just too big by itself. It's also a linchpin for North Asia and ASEAN, but it's too big for us to have an impact by ourselves. So we need somebody who's strong and capable to become a partner. And so I think for that last category, the Western tech companies are looking for a different range of partners. Sometimes they're the same people, but an aligned strategic. So it might be that the Chinese partner is in the tech space, either in an aligned or complementary tech space. And the advantage of that is that partner understands tech and can roll out the business in China. Deep pockets strategic. So this company has deep pockets, but is interested in the technology. That can be a little bit more difficult to negotiate, but it's interesting. And then deep pockets, many hands. There is really, starting from 3 years ago, China really has a large private equity, funds, VC, but also local government funding. So there's a lot of money for the right kind of technology, which is collaborating with the Chinese champion. And so we've seen a few companies already set up in China with a very clear idea that they're going to do an IPO on one of the Star Exchange, or either on the Star Exchange, or back the business into a listed entity, or it will be sold to a large Chinese player at some stage. So this is something relatively new we've seen in the last few years. Okay, joint ventures, I think, 20 years ago, the common wisdom was don't do a joint venture. I think that's changing because joint venture was always a bit of a bargain struck between the Western company seeking market access, or in the past, they were seeking access to cheap labor, etc. And the Chinese company was seeking new business or technology. And this is the bargain today. The Western companies want access to the Chinese market, and the Chinese company want to also get into the new business or technology. And for this reason, most joint ventures have a life cycle. I would say most of the joint ventures we see, after 10 or 12 years, something will happen. So I think it's important, even when you're planning your entry, think a bit about your eventual exit. Joint ventures with Chinese partners can be massively profitable, especially if there's an IPO, but you're going to have to do compromises. It can't be that it's a 50-50 joint venture and you're 100% in charge of things. So headquarters needs to be actively involved, and you have to kind of understand and invest in the relationship with the Chinese partner. And then one last issue is, if you really want to make it big with the IPO or sell the company to a listed company, you will probably have to transfer or at least irrevocably license for the Chinese market some of the core tech. And this core tech may evolve differently in China than it did in its home market. So the third question is, when we're looking at how you would enter into China, there are these different options: offshore model, wholly foreign-owned enterprise, wholly foreign-owned enterprise with a VIE, or an M&A, or a joint venture. And I think here we've just put in this table, the licenses, because that's important, the timing, because timing can be very different if it's a joint venture or it's a wholly foreign-owned enterprise, the advantages and the complexities. So I won't go through each line of this, but I think these are the main issues to consider when you're weighing up different options.
Mark, is there any of these options that a certain type of tech company would prefer over any of the other options in terms of what might be easier for this type of tech business?
Well, I mean, it's complicated. It's not easy to answer, briefly. I think if you are, if you're something like a bit of a niche business and it's a consumer-facing business, so there's not invoicing issues, I think if you're an online education business, probably you would be happy with an offshore model and look at how you can get licenses in the future, because that's a very complex licensing regime. Or if you're in the media business, something which is off limits, you might look at it. I think Woofy would be for anybody who's a niche player, somebody who doesn't really feel like they need a Chinese partner to succeed, and there's no legal restrictions. And then I think with Woofys and VIEs, it's normally somebody that has a good business, and there is a certain part of the business where it needs an operational license that it cannot get by itself. And so it would be rare that the whole business is built on the VIE. So I think that's it. I think, like I said, joint venture partners used to be more about legal restrictions. I think nowadays it's more about economic reasons for having joint venture partners.
And to everybody watching, please feel free to pause the video or shoot us a question if you have any questions. Thank you for watching the second episode in this mini-series, Entering the Tech Dragon. If you have any further questions or you're looking for more information regarding some of the business models we have discussed, I will put in the description of this video links to previous webinar episodes that we have done that will dive deep into these different business structures that you could use when entering the China market. The next episode of this mini series will dive into VETS licenses.